Yo, yo.
What is going on?
Oh, just a chilly Friday. Friday the 13th?
It is Friday the
Oh,
13th.
didn't realize that. Great.
It's been quite some time since we've done a live stream.
When? I don't even know the last time we did one. Probably a few months ago.
Yeah, it's been a while. It's
Yeah,
the market's changed, man. The market. I feel like I blink and every day the market changes.
it was with Mr. Zach. That's
Hmm.
right. Yes, that was April, March, April. That was a while ago.
Yeah,
Yeah,
5 6 weeks ago.
just just a couple changes that have happened in the last 4 months. So
Yeah,
more than that, I guess. 6 months? 6 months?
yeah, 6 months, half a year. Things have the market has drastically changed. Um, we got a lot to talk about. So I phenomenal being back at the channel. Really appreciate everybody obviously tuning in. You know, this market is something that is ever changing, and as things change, policies change. Uh, products change, investing strategies change, investors change the way in which they invest and move their capital around. There's a lot going on, and who better to have on to chat with us today, which is somebody or an investor in locally who has gone through it, who has done flips, who's done burrs, who now does multifamilies, who is seasoned and does this full time. We are really appreciative of having Carlos Afanador on. If you guys don't know who Carlos is, Carlos invests in the London area. He is a past client of ours, a friend, and somebody we look to have phenomenal real estate chats. So that's who we have on today, guys. We can introduce Carlos.
Hello, hello.
What's going on, man? How are you?
I'm doing all right. I appreciate the introduction.
Yeah, big intro for a big guest.
There you go. Big pump up. I'm excited.
Well, yeah, appreciate you coming on, Carlos. We could sit here, we could talk about real estate forever. Aaron and I are really jacked up to have this conversation. I know we talk on the phone a ton about the intricacies of what's going on, but for the people who don't do this full time or don't know you, why don't you introduce yourself, a little bit of what you do, how you do it? We'll get into some nitty gritty.
Yeah, for sure. So, I like Josh mentioned, I am a full-time investor. I've been full-time for 3 years now. So I started in 2020, coincidentally, when COVID hit. That's when I went full-time. First property I bought was in 2014. So I've been investing in real estate in theory for 9 years here. I started aggressively investing, burring, kind of putting more of my focus into real estate in 2018. So it's been about a 5-year journey of me going pretty hard at real estate. I went from student housing to now my most recent project, which is a 32 unit multifamily building, all without partners. Um, so that is my resume at a high level. I mean, we can go into the intricacies of of each property and how I guess I graduated from student housing to a fourplex to a 7 unit to an 11 unit to now a 32. We can get down to the nitty gritty of it, but that's my overall summary. During That's on the rental side, and then there's the flip side of the business. So I have two businesses. One of them is the rentals, which I just described, and then the other one is flipping. So during the massive spike when people were going crazy from 2020 to 2022, that's when I was flipping quite aggressively. So I think I did 12 flips or so in a year. So that actually obviously got me a lot of capital, and then I used that capital to invest in multifamily. So that is a high level summary of both the businesses, and obviously there's a lot to talk about. So I'm excited to be here with both of you guys and discuss things going on in the market today.
Yeah, I think you kind of touched on what most like new to intermediate type investors are kind of questioning, and especially right now in today's market where liquidity is super crucial, but also at a super low point for a lot of investors is how is someone able to start off with their first rental property and get into, a 6, 7, 32 unit apartment building? What different ways are they able to generate that cash flow right from the get-go to be able to get into, these higher liquidity type asset classes? Is it getting into JV partners? Is it doing flips on your own? Is it, doing buy and holds, conversions? Maybe you want to touch on, for you, kind of where you started out from, what your capital, looked like somewhat, and then what you found was the best way to be able to kind of get in and out of products and grow that capital stack to allow you to get into now large multi-unit asset class.
Yeah, so I wish I had a magic answer for you guys. My experience was a little bit different than someone starting today, obviously. I started out with a $14,000 capital investment, which today sounds like a joke. Mind you, this was in 2014. Obviously, at the time, I did nobody knew what was going to happen. So, $14,000. Then I started saving, bought a second one, a third, and then I started borrowing from there. So my experience, I mean, we can get into it if you want to, but it's going to be completely different from someone who's starting today. That being said, there are a lot of opportunities. Right now, I'm seeing a lot of properties going into receivership, meaning that the owner has collapsed on their mortgages, and now it's basically with the lawyers, and they're just trying to get their loan back, which obviously presents an opportunity for the buyer to buy at something that's relatively cheap. Now, obviously, we're seeing high interest rates. Things are difficult to acquire, and I understand that. But if you are able to find a way, whether that's through JV partnerships, finding OPM of some sort, whether that's through family members or through raising capital, if you're able to find that capital, I think today presents a lot of opportunities to buy at a low rate and perhaps add more units. You need to be creative in today's market, I think. In London, where I invest, we have now recently passed 4 units in single family residences. So if you buy a single family home, I mean, there is some red tape that you need to follow, but you are able to make 4 units. So if you buy a single family at a single family price today, you make it into a fourplex, you hold on to that for 5 years, you're obviously going to do well on it. Now, definitely easier said than done, but that was not an opportunity that was presented to me when I first started. So for me, the opportunity at the time was, well, yeah, things make sense. I bought a house and I'm cash flowing $1,000. That's not something that you're going to be able to find today. However, I was not able to get a single family and easily convert it to a fourplex. So that might be an opportunity for someone who's starting in today's market. We're seeing a lot of office conversions. Now, that's at a bigger scale, but I know some of you guys, I believe Nick on your team is doing an office conversion. So there's an opportunity there. I know someone else closely who's doing an office conversion in Exeter. I've seen 2 office conversions here, St. Thomas, one in London as well. So those are the plays that are now an opportunity that weren't available to me back then. So I think it's very easy for people nowadays to say, well, this guy started in 2014, things were cheaper. That is true. However, there are other opportunities that are available now that were not available back then. So I just think it's a matter of getting your foot in the door. I think for the right person with the right mindset, they'll find a way to do it. They'll find the money, they'll find the JV partner, they'll reach out to you guys, and maybe you guys can guide them. They'll find a way to get it done. But yes, I think there certainly is opportunity. You just have to get creative and find a way to make it happen.
Yeah, I think as the housing shortage continues and we continue to see the government and municipalities open up, different zoning bylaws and allowing for these density changes. I think the more we stay in the shortage, we're going to start to see more opportunity presented by the government for investors to be able to take advantage of it. Right. Obviously, construction projects and infill stuff like that, requires a little bit more money than just your casual flips and single family to duplex conversions. But for investors that are trying to take a look at which pathway do they want to start moving forward to and where do you want to kind of specialize in, I think seeing the need for units and these changes that are coming, I think that's a pretty strong focus to or avenue to focus on. I think we've talked about infill probably like coming in from last year, coming into this year, and we've mentioned that a few different times. So here we are talking about info, again. So
yeah, and I think it's government at all levels, right? Because again, we can have a deep discussion on this, but on the federal level, I mean, if you're dealing with large multifamily, CMHC, as you guys discuss often, that's all federal funding, right? So obviously the government's really trying to promote building housing, incentivizing developers to do things like affordability being one of the MLI ways that you can gather points. They're really trying to promote developers to build affordable housing or create affordable housing. Like I know in London where I invest, there are several grants available for people that, like, if you're listening to this and you're from London, you can look this up online. If you're in the downtown area or if you're in Old East Village, there are renovation grants available. And often those are surrounding, I mean, they're obviously trying to give the city a facelift, but they're also incentivizing affordable housing. So I see it I've seen it on a municipal level and then obviously on the federal level as well. So yeah, I think government's definitely helping out and they're trying to generate opportunities.
Trying. I mean, it's
helping.
I think you hit it right on the head, Carlos, when you said like the opportunities are different. When you're starting to invest and you invest in a market that is forever up, you flip the capital into something much larger. I think what we're seeing now, and I think Ehren can echo this, is the amount of capital required to really do some of these projects now is drastically increased. And I'm seeing a lot of investors, like novice investors, it's definitely getting more difficult to be able to get into the game. If you're looking at a conversion project, $1 million, you're looking at a multifamily, which, I mean, most deals don't work anymore unless you're moving into CMHC, which is 5 units and above in a regular market, at least $1 million in the buy.
Right.
The amount of capital required to really start playing the game, continue to play the game, is shrinking. And the amount of people that are going to be able to get into it or have access to get into it is also shrinking. The pre-con market, which was the average investor was getting into, is completely decimated. It's
right.
Values are less than what they bought them for, and people are defaulting on their closings. It's not doom and gloom, but the opportunities are changing, and understanding where to look and how you're going to make money in the next decade is a question that we're getting more and more every single day. And we've been echoing this for the last 2 years, but I truly believe multifamily real estate is the way in which investors are going to continue to make a profit throughout whatever recession we're about to go through.
Right.
Just due to a handful of reasons. One is direct comparison approach. Like if values are going to be dropping based off somebody else's sale, if you want to have the ability to be able to increase the value of your asset, it's going to be by increasing the net operating income. Same reason why people got into it when COVID happened. I think that's going to continue to stay true because investors are sick of not having control of their returns. So, those multifamily opportunities, those infill opportunities, you might not be able to do these things alone anymore. You might have to get 2 or 3 people who are aligned to understand what you're doing and how to execute in the market. But for the right opportunity, there are some smoking deals right now. Like, what are you guys seeing in the market for deals?
Yeah. We're definitely seeing opportunities for deals. Like the way I operate is I submit offers. They're not offers that the seller wants, but it's kind of like a car dealership. When you go give your car to a car dealership, you're not expecting top dollar, but you're expecting convenience and ease. And that's basically what I offer.
Yeah. Do you cringe a little bit when you hit the send button?
What's that?
Did you cringe a little bit when you hit the send button?
No, man, I just send text. I'm literally like some people are like, well, you have to do an APS and all this. And I'm like, yeah, but that takes more time. So all I do is I'm like, here's my price, deposit, closing, like text. And then they're like, yes or no. 99% of the time they say no. But when I get that 1%, that's the one, right? I think it's definitely, I mean, no question, it's a different market. I wish I had an answer for someone. All I can say is you have to get creative. I know, for example, in other places, they'll literally split like between 5 people a single family home. But if that one's a home run, you're better off to split that with 4 others than to keep working your day job and just keep making your income. You have to get creative. I wish I had an answer for you, but I don't for the newcomers. I think if you're just starting to invest in real estate, the best play is that you have to learn how to use OPM. You have to educate yourself on other people's money, raise capital, learn how to do it, at least in theory, so you can show some legitimacy to some investors, but you have to raise capital. Once your foot is in the door, now you're growing with all the other investors, but you need to get your foot in the door. And I think the times that are coming will present a lot of opportunities to do creative financing like VTBs or opportunities that you can present to other investors. But yeah, you definitely have to get creative. The days of buying a single family home just on your own and making a profit and growing from there, I think are done. At least as of now, who knows what tomorrow will present. But I think right now, especially with inflation going back up, I mean, I don't know what's going to happen, but yeah, I think we're about to reach some tougher times. But with those tougher times, as long as you set yourself up, there's going to be opportunities presented to you.
Yeah, I think you have to, be able to adapt your strategy with the market. In today's market, you don't have the help of a hot market to just inflate, your value. You have to rely on true value add type projects, taking a single family, converting into a 4-unit building. That's something that is going to, without a doubt, increase the value of the building. You're not going to have, hassle with the appraiser trying to, hey, I took the single family and, even though it had a basement suite, I converted into a fully one. Like, you're not going to have to start trying to split margins and try to force that value out. If you do these true value add type projects, you're going to get the project, the value on the end. And these multifamily type projects, it's a lot easier to start taking a look at the value, because now we can start taking a look at net income approaches, where the cap rate's at, where the market interest rate's at, and we can start kind of projecting, that value a little bit easier. Again, it takes a lot more money, so you have to figure out how to get into it. But using other people's money is a great way to be able to get that done. And like you said, if you hit that first one and the numbers work, that might be the last time you have to use OPM. It takes one good project to get out of OPM and private money and back into conventional type financing. So
I think that's a great nugget for someone who's starting out. All it takes is one good deal. Just make sure that you actually know what that means. If a realtor tells you it's a good deal, doesn't necessarily mean it's a good deal.
I double check.
That's the realtors on here, but yeah, I don't know if I should have said that, because now the realtors are going to want to work with me. I'm just kidding.
But in case anyone's wondering, Carlos doesn't sign exclusively.
Yeah, but make sure that it's an actually good deal. And all it takes is one. Once you got your foot in the door, you got one good deal. There's your nest egg. Hopefully that's enough to keep growing. If not, you got to get creative. There are other avenues that require very little capital, like wholesaling. Essentially requires little to no capital. Again, if you get one good wholesale deal, again, it's challenging, right? This stuff isn't easy, but if you're able to get one good wholesale deal, there's your nest egg. If you're able to get a JV partner, there's your nest egg. Like me, for example, I didn't come from, I remember looking at programs like Keyspire. And if you're unfamiliar with Keyspire, it's Scott McGilvery. He's a good looking guy from HCTV. He has a program where basically he has a bunch of investors connecting, and then they network and they raise capital, et cetera. I was like, I don't know investors. I don't know rich people around me. But there's a lot of them. And I feel like you guys are I always tell, I speak with Josh often, because I bring deals forward to him pretty often, but I always tell him he's like a nucleus, right? And I think Josh and Aaron are good resources for anyone watching this to reach out to. If you don't know anyone who's wealthy, they might be able to connect you in the right way. But yeah, another thing I didn't have back in the day. So there's another tip for anyone who's watching. Make sure to read your resources, and you guys are a resource for these people. So let them know.
Yeah, I think, to that point, I think you have to do some research into who you're kind of using as a mentor, or the groups that you join as well. Especially in today's market, there's a lot of products that are easy to kind of use as clickbait to get people in. Especially the MLI Select product that came out last year. To see someone talking about, hey, you can now build apartment buildings for 5% down and get these super low interest rates. it's very easy to get caught up in that hype and say, oh, hey, I'm looking for a home run, and all I got to do is put 5% down and I can build this huge building and refi and take it all out. I don't, the number of files that actually get in construction wise on a 95% loan to cost, it's very few. The majority of them don't actually tend to value out at 95%. Most of them are probably somewhere around like 70 to maybe 80 if you have a really good project, maybe 85, but you're definitely not getting up into that 95%. So, I mean, you really got to be careful. Yes, it is an option, and yes, you can get up there, and the 50-year RAM and all these point structures, it's all there in theory in terms of the structuring. But again, if you're buying a building and that amortization, that remaining economical life isn't 55, 50 years, you're not getting the 50-year RAM. If you don't have the income to come in on a brand new project, you're not getting that high loan to value. I think, I've seen quite a few people, and I know Josh has, and a lot of our agents are seeing a ton of construction stuff come in right now. That 5% down, even if you could get something 5% down, you still got to factor in all the additional other costs that you have. You're going to have your fees. You're going to have any sort of like land transfer taxes. You should have additional at least 15, 20% of capital stack as well too, even though you only need 5% down. CMHC, they also require net worth. So, I mean, you got to have 25% of that loan that you're going to get as well too. So, just that 5% number can be a little bit misleading. So, going back to my point, depending on the groups that you get into, you do have to just make sure that they're able to give you the full story and really guide you through step by step, and not just kind of flashing some really pretty numbers at you and saying, hey, here's what you can do, come learn and take my program. And it's not a shot to anybody in specific, just, as an investor, especially new ones, really make sure you do all the research and read everything, and also talk to the guys on the financing side so you can get the full story from that end as well too.
Yeah, for sure. Echoing Aaron, it's really easy to see a shiny thing and to think that's a great way of being able to do it. But, understanding the actual intricacies of how these debt facilities work. I know professional mortgage agents who don't understand how these work. But they're complicated. No, but they are though. Like the intricacies around how this debt moves is very complicated, and it continuously changes. So, if you are looking to be a little bit more creative or take on a project, especially, construction, where we think construction is going to become quite large opportunity in the next little while, just due to what's happening in the market, just understand exactly what you're getting yourself into.
Yeah, I kind of had a chuckle when you said 5%, Aaron. That's definitely not what you need.
Yeah. And I mean, and there's so many things that we could talk about, but yeah, depending on your loan size, a lot of these conversion projects, especially if you're 4 and under, you're not getting CMHC anyways.
Yeah.
But the loan sizes for CMHC construction loans, when we're looking at CMHC, you got to be like 8, 9, 10 million in loan size before most lenders are even going to give you the time of day. If you're a repeat customer and you're bringing something in a little bit lower on loan size, you might be able to get it done. But the majority of these projects, you have to be 8, 9, 10 million in loan size before CMHC is even going to consider you. And then, depending on your experience, if you're, I mean, to be blunt, if you're a first-time builder or investor and you're trying to get into a development project, you don't have the experience to get qualified with CMHC, and you're not going to get the 5% down. And then, by the time you bring on an experienced enough builder, your costs are going to be, you got to add in the fact that you got to pay the builder to get it done and all that stuff as well too, right? So, but being aware of what your limitations are, even with now, on SPA essentially being removed for 10 and under, a lot of these 10 and under products probably aren't going to qualify for CMHC on the development as well too. So you're still going to have to find a way to bring, 25, 30% down to the table when you take a look at purchasing, plus the amount of money that you're going to have in contingency for the construction. And then maybe you can flip it into CMHC on the refinance. But on the construction side, a lot of these fast track type programs you're bringing out aren't probably going to qualify for construction financing anyway. So you're going to have to find some sort of alternative means of getting the construction done.
Yeah, I agree with that. And I think these programs that are coming out are good, but they're also a little bit dangerous because, like you guys said, they're flashing a shiny object in front of people, and that doesn't necessarily exist. I know with this project that I'm working on right now, this 32 unit, I mean, it's without saying, it's very capital intensive. but it's more capital intensive than I thought. When you're seeing this amount of money leave your bank account every month, it's real. So you got to be able to deal with that, not only from a numerical, looking at your numbers, making sure it works standpoint, but also being able to handle that amount of stress and that amount of pressure to, holy shit, this is like hundreds of thousands of dollars going, right? Like every month at the beginning, if you're renovating, like property taxes alone, which is one of several expenses, is 60 grand on this property. So and then that's not to mention the loan amount. You have to get acquisition financing, which is expensive. You have to know how to renovate. You have to follow fire codes, which are big. You have to follow building codes, which are quite strict. I mean, there's a million and one things that I can go on, but yeah, it's not for everyone. I think, I mean, I love what I do. And I think that for the right person, it's a like MLI is a great tool to use, but I think it's a little bit too shiny for new people. I think they should stay away from it. It actually, in my opinion, would be, you're better off to look away, have your horse blinders on, and try to get something in the smaller space before you even think about MLI, despite how attractive it might look. Because in my opinion, it's more likely to bite you in the ass than to help you.
Especially when you're trying to execute on MLI using energy efficiency. Like, it's an expensive way to get your financing done. And if you have the capital to play the game, like, sure, it works in theory, but like, if you're talking about, if you got a larger project, serious capital expenditure and being able to make these points. So
between your appraisal, your environmental, and your energy audit, you're almost 20 grand. So like, it's right there. You hadn't even started anything else.
Do you remember how much capital I had? Do you remember how much capital I had locked up before I even acquired this asset? I think it was like, the deposit was 100,000. So that's 100 just for the deposit. And we had the phase 1, phase 2. I think it was like probably like 150 locked up. And that's with the chance of not even closing because we didn't have everything in line. So, you know, I think it's important to set these numbers in front of people who want to get into the space, right? Because it's real, right? And that's even before you acquire it. So, and I'll tell you, it was a lot more than that when you actually get the ball rolling. So it is scary. And then there's the actual financial aspect of it, but there is a stress part of it. You got to be able to handle it. You got to stay cool. It's been a little bit of a challenge for me, despite how many deals I've done. So it's not for the faint of heart. If you're going to get into like a bigger project, MLI Select, just make sure that it's not just numbers. There is a hell of a lot of work, a lot of stress. You have to manage a lot of people, a lot of pressure coming at you. So I definitely recommend it if that's your vibe. But I think there's very few people who can actually tackle it, especially if they're relatively new.
It's good to hear from somebody who's doing it or somebody who does it. Like, you know, it's very easy to say, buy this for this, put this much in, this is what it's worth, this is what you're getting back. You know, people forget about all the mini heart attacks along the way and all the things you have to do along the way.
Quite literally.
To actually do that. And the saying, if it was easy, everybody would do it, is so true. And especially in a market like this where we're seeing, you know, people who are feeling the squeeze inside, you know, these projects right now, it's an interesting time to be an investor. But blood is, you know, what is it? He says, you know, buy when there's blood in the streets. I think that's what Warren Buffett says, or buy when everybody's running, something like that.
Yeah.
Like, there's opportunity. We're seeing it. You know, we're seeing massive VTBs in first position on multifamily buildings. Like,
VTBs everywhere right now.
Everywhere. People are offloading assets. So if you guys are watching this today, there is opportunity in the market for the correct buy. Now, at least since Aaron and I have been mortgage agents, there's never been a better time to buy a property. You know, you have all the power. You can choose when to close. You can choose your terms for your VTB, how much it is, how long you need it. You know, if vacancy on possession. And there's so many flexibilities now as a buyer if you have cash to be able to make a move in this market. You know, I'm seeing a lot of our clients who restructured debt 6 months ago, 8 months ago, who are sitting on the sidelines and waiting, is starting to, you know, nibble a little bit, starting to take a look at these opportunities now. I think the guys who have gone through cycles, you know, we're very new. Like, realistically, we haven't been through a full cycle. Full cycle is what, 7 years, 8 years? Like we
Right.
haven't really seen the depths of what happens when shit hits the fan.
Yeah.
And I think that the guys who have seen it, the guys who've gone through it and who manage their portfolios effectively through the highs also know what it's like buying in the lows. So those nibbles from big sharks are starting to come out.
100%. Yeah, it's hard to time the market, but that's what we're all trying to do, right? Like I was talking to you earlier about a potential deal that we have going on right now. And what I'm on the fence about is, should I buy now or should I buy next year? Right? Because what's next year going to look like, right? Are you more bullish or bearish on it? Like, that's a conversation that I guess we won't know the outcome until next year comes because there's so many variables. But if you are bearish, it might make sense for you to hold off until next year. Like that might actually make you more money than not. But at the same time, maybe not, right? There's no one has that crystal ball. I guess all you can do is just try to find deals that make sense. But yeah, I feel like there certainly is. You're already seeing, like you said, VTBs. You're seeing a lot of office conversions come out. You're seeing government aid, right? Which helps in some ways. So yeah, I just think the opportunities are different, but they're definitely there. And as far as holding down during the storm, if you already have assets, a lot of people are keen on losing like, a couple $100s, couple $1,000s a month if they're negative cash flow during this period. If they get hit with a mortgage renewal or whatever the case is, they're like, oh my God, I'm going to lose X amount per month. And yeah, that's true. But if you're able to withstand that and you're able to withstand that for 5 years, the amount that you'd gain on the equity piece is more than likely going to cover all those sunk costs that you had during the negative cash flow period. So if you're able to do that, I recommend you do. But I think a lot of people freak out at the negative cash flow, which is a couple $100s, a couple $1,000s a month, which obviously sucks, but they forget about the equity piece, which is way larger. Your equity, you're talking tens, at least 10,000s, 100,000s, and if you're in the bigger space, millions, right? So that's where the real meat and potatoes of real estate is in the equity side. So if you're able to withstand the storm, I recommend that's something that you do as well.
Yeah, I think I talk to a lot of clients, more so on the res side, but they're looking at a portfolio, trying to buy more, trying to figure out, do I sell? Do I deleverage? What do I do? And I think, you definitely have to sit down and figure out what do you like. Are you a cash flow person? Are you an equity person? Like which kind of pathway are you going? But I also talk about are you buying your equity? You might be, maybe you're short $300 a month when it comes down to your property, but for $300 a month, you're essentially buying that equity coming down the road. So you can start figuring out, okay, based on a normal market, not this 40% appreciation, but getting down, back into the 7% appreciation. If you want to wait that out 5 or 10 years at $300 a month, like what's your return on you, quote unquote, buying that equity, and what does that look like, down the road? You can do the same thing, taking a look at the larger multifamily. If you can find a good deal in today's market, in 3-5 years when rates really start to come back down, that's going to be an even better deal. Once the interest rates drop and the cap rate shrink, the value of that building is going to start to skyrocket, and then you're going to have lower cost of carrying capital, better CMHC rates. You're going to be able to tap into a lot more of that equity, or sell it at a much higher point. So if you can find a good deal in today's market, especially on the multifamily side, understanding how the interest rates work and understanding how the cap rates work in conjunction with the interest rates in the bond markets, and being able to look ahead and seeing, okay, we should start to come back down in the next, sometime between 5 years, 7 years. What is that building going to look like, and what does that mean for you down the road? I think there's a lot of big potential, specifically on the commercial side, for guys to pick up these buildings and carry them for the next 5-10 years.
Yeah. No, yeah, but without a doubt, I think the opportunities right now will echo through a generation if you can take the opportunity and truly start to build your portfolio when you're making all your money on the buy. So, I think great chat, guys. Like I really appreciate Carlos coming on today. Your experience is invaluable, man. People are trying to find a way to be able to invest in a market, and being able to hear from somebody who does this professionally, does it full time,
Right.
Aaron, I really appreciate you coming on and chatting with us today. If people do want to reach out to you and do want to connect with you, your is down below for Instagram. Guys, if you guys want to reach out to either Aaron or myself, follow either Laycock22 or JFins. We really appreciate if you guys did make it to the end of this video to hit the like button and hit the subscribe button. It allows us to make more content like this for you every single week. So we really appreciate everybody tuning in, and we will see you next time.
Thanks for having me.